All right, let's dive right in. Today, we're doing more than just a history lesson. We are cracking open a playbook from a master strategist written during a time of, well, some pretty intense economic turmoil. We're going deep into Warren Buffett's 1978 letter to shareholders to pull out 5 lessons that are just as critical today as they were then. And trust me, these aren't just quaint little principles. This is a framework for thinking that is incredibly powerful for any serious investor. So, right off the bat, Buffett doesn't start with a big victory lap about earnings. Nope. His opening shot is a direct challenge to standard accounting. With just this one sentence, he's basically telling everyone, and he's telling us, you've got to dig deeper than the numbers on the surface. This really sets the stage for everything that follows. It's all about a relentless hunt for the economic reality, not just the accounting fiction. And that leads us straight into the first core principle from his playbook. You have to learn to look beyond those headline earnings numbers. For Buffett, this means you've got to be willing to get your hands dirty and deconstruct the financials yourself. You see, back in '78, Berkshire was this collection of totally different businesses. We're talking textiles, insurance, candy, you name it. And Buffett is incredibly blunt about it. He says that the consolidated view is a report we never prepare for internal use and that it's of no value to us. Think about that. The takeaway here is huge. If the guy actually running the company says the main report is useless for making decisions, why on earth would an outside investor treat it like gospel? The real story, the real value is hidden down in the individual business segments. So once you start tearing the numbers apart, it naturally leads to the second lesson. You have to get really good at analyzing the anatomy of any business. Is it a gem that's going to compound your wealth for years, or is it a dud that's just going to eat up capital? And here's where he gets brutally honest. He uses his very own textile operation as this powerful cautionary tale. There's no ego here, no trying to pretty up a bad business. He just lays out the harsh economics with total clarity. This isn't just a report, you know? It's like he's performing a public autopsy on a problem he is dead set on never repeating. And this slide just lays it all out, doesn't it? It shows the stark contrast he's painting. Over on the left, you've got the anatomy of a really tough business, like textiles. It's a commodity, it's constantly hungry for more capital, and it has zero pricing power. Like Buffett says, in that world, your price is basically set by your operating costs, not by your return on capital. But then, on the right, you see the ideal he's hunting for, a business with a unique product, low capital needs, and the power to name its own price. That right there, that's the mental model every investor needs to have burned into their brain. Okay, so you know how to analyze a business, but how do you actually decide when to pull the trigger and invest? Well, that brings us to lesson number 3, Buffett's crystal clear 4-point checklist for making big equity investments. And here it is. It's so simple, but so powerful and absolutely timeless. First, can you actually truly understand the business? Second, does it have favorable long-term prospects? A real durable competitive advantage. Third, is the management team not just competent, but also honest? And finally, the fourth gate, the one he says often stops you in your tracks, is the price really attractive? You need all 4. This isn't some vague philosophy. It's a disciplined, ready-to-use framework. And this, right here, was the massive opportunity Buffett saw in 1978. The stock market, what he calls the auction pricing mechanism, was basically serving up pieces of fantastic companies for way less than what corporations were paying to buy mediocre companies outright in private deals. It was just this massive, glaring inefficiency sitting there, waiting for someone to take advantage of it. And just look at this data. In a pretty scathing footnote, Buffett points out this absolutely stunning fact. In 1971, near a market peak, pension funds, the institutions with the longest time horizons imaginable, poured a record 122% of their net funds into stocks. But by the time the market bottomed out in 1978, that number had collapsed to a record low of just 9%. The so-called professionals were acting like total amateurs, buying high and selling low. And that's the emotional tide a true value investor has to be willing to swim against. Now, this kind of contrarian buying leads to a really powerful and, honestly, a kind of counterintuitive idea. You don't actually need to control a company to profit from its greatness. This is the whole logic behind passive investing. I mean, this seems kind of obvious when you say it out loud, but it's a truly profound strategic insight. Why would you pour all your energy and capital into trying to fix a mediocre business that you control when you could just passively own a piece of a truly superior one? And for Buffett, his investment in SAFECO Corporation was the perfect case study for this very principle. This quote just perfectly captures his whole approach, doesn't it? It's so humble and so pragmatic. He's openly admitting that SAFECO's management is better at running their insurance business than he would be. So what's the right move? Buy a piece, sit back, and let them do what they do best. Ego has absolutely no place in that calculation. And this right here is the engine that makes passive investing so incredibly powerful. See, the value isn't just in the dividends you get in your pocket. Buffett argues that the earnings a company keeps, the retained earnings, are just as valuable to you as a shareholder. But, and this is a huge but, only if management can reinvest that money at high rates of return. A dollar kept by a brilliant capital allocator is probably going to turn into a lot more than a dollar paid out to you today. So that brings us to the final lesson, the one that really ties all of this together. The ultimate edge in investing? It's not some secret formula or a complex algorithm. It's a mindset. This is basically the highest praise Buffett can give a manager. He's talking about folks like Gene Abiget at his bank or Ben Rosner in his retail business. These aren't just hired hands clocking in and out. He says they have a passionately proprietary attitude. They treat the company's money as if it were their own. So what does this owner's mindset actually look like? Well, it's not just one thing. It's this relentless focus on keeping costs down, combined with a real knack for allocating capital where it'll do the most good. It's having the patience to think in decades, not just quarters. And as Buffett so charmingly puts it, it's about actually enjoying coming to work in the morning. This is the qualitative DNA that ultimately drives those superior quantitative results. So here it is, the final point. Buffett's entire analytical framework, from ripping apart financial statements to running through his 4-point checklist, it's all designed to achieve one goal: to find and partner with these owner-managers. And his final argument is that if you, the investor, can adopt that very same mindset, well, then you will have the ultimate durable edge in the market. And that leaves us with one last, really critical question to ask ourselves. When you look at your own portfolio, have you done the work to see past the ticker symbols? Do you see yourself as someone who just owns a bunch of stocks, or as a silent partner in a collection of actual businesses? According to the 1978 playbook, the answer to that question really defines your entire approach to investing.